Wow, what a week we just finished. We saw a lot of action. It was all down Monday, Tuesday, Wednesday, Thursday until Friday. And then we saw Powell come out and give a speech at the Jackson Hole Symposium. And it was more dovish than what people were expecting. And that pushed the stock markets higher on the day. We'll take a quick look at that today because there's a lot of different interpretations of what this speech really means. There are some nuances. I won't spend too long on it, but there are some indications of changing policy here, which are very interesting. And we'll take a look at what happened the week with some of the earnings and coming out this past week as well. What happened to the technology sector? That was a big one this week. We'll go through and we'll take a look at what happened with inflation for Canada as well, because we saw some key inflation numbers come out and what that means for Canada. And then we'll take a look later on at what we can expect next week. We got some big earnings coming out next week. This is late in the season for earnings, but it's Canadian Bank Week coming up. And also we have NVIDIA as well. And what could possibly happen this week with the stock market as well. So let's jump right in and take a look at the market action last week first. So the previous Friday was negative, Monday was negative, Tuesday negative, Wednesday negative, Thursday negative, and here's Friday. Okay, so in the end, the S&P 500 was down 4 days in a row last week and then up on Friday, which made up for the rest. So we did see a small gain for the S&P 500 last week. So if we take a look here, at the S&P 500 was up 0.2% for the week. It's important to note that technology was down 1.2%. So a lot of that was focused on the AI stocks, and we saw some action there this past week with the general belief that perhaps the AI stocks have just gotten ahead of themselves here. And so we did see a pullback in stocks such as Palantir, a big pullback. It was down over 20% at one point during the week. And that affected the technology sector. And we have seen the technology sector continue to roll over, which is interesting. So the big winner here was energy. Energy's, is in a strong seasonal period. It's not one of the stronger seasonal periods, but it is one of the seasonal periods of strength for the energy sector. We are starting to see the energy sector improve here a little bit, and that's good news. And we saw healthcare up again this past week as well. We saw real estate up. There was a lot of risk on that. Really, a lot of this action was from Friday with the action taking place. And consumer services, communication services was down 0.2%, which is interesting. And consumer discretionary was up 1.7%. So a really mixed picture on the growth side of the market. If we take a look here, small caps did really well last week, 3.2%. Small caps have actually been performing quite well recently. They've just been so badly beaten up. Any risk on move all of a sudden is moving that sector higher. The TSX was up 1.6%, so that's a solid gain. Europe up 1%. Emerging markets down here a little bit as well. And the NASDAQ was actually negative for the week. Dow Jones, look at this, was up 1.5%. So the Dow Jones outperformed the S&P 500 in the first part of the year when we saw that risk-off move taking place. And because that really was a flight to value, dividends, and which is more of the Dow Jones compared to the S&P 500. And so then we saw the S&P 500 do extremely well relative to the Dow Jones. But recently we've seen a rotation back into that other sector of the market as investors are starting to shy away from some of the growth sectors, going into the value sectors and into the Dow Jones as an example. With the expectation of lower interest rates, we saw U.S. banks do extremely well. Home builders do really well, despite every report coming out of that sector being poor. This really was a knee-jerk reaction, pushing the sector higher. Uranium was up, not very much though for the week. And if you take a look, metals and mining did really well on Friday, but the rest of the week it was down. It went down more than the market. I'm going to be actually doing a video this week on the metals and mining sector. Please like this video and subscribe as well. That way you can keep up to some of my other videos I do on the different sectors, some of the technicals, some of them really short, some like 1 or 2 minutes as well. I'll just go over what's happening on the seasonality with the different sectors. I'm going to take a look at metals and mining this week because that does indicate a little bit the performance of the sector, what's happening in the market. And I'm going to go back and look at some of the historical trends. Silver did extremely well. Gold miners up 3.3% and gold up 1%. So that gold responded very well at the end of the week when there was an expectation of the Fed moving into a cutting cycle. And I will also do a video this week on gold as well, talking about where gold is, because it has been a consolidation pattern, and go back and look at some of the historical examples of what's taken place, take a look at the volatility of gold and what we can see coming up shortly for gold perhaps. Okay, so it wasn't all about Friday. Yeah, it was extremely important, but what we did see earlier in the week was we did see several Federal Reserve governors come out and basically say, well, we should not be in a hurry to cut interest rates. As with inflation above target. So it's talking about inflation, all about inflation. Inflation is the most important aspect. Then we saw another governor, Hammack, come out, and she's not going for Powell's position for sure. I mean, she's made several hawkish comments in the past, and basically she said here, we can't see the full tariff effect until next year. And basically saying the Federal Reserve really needs to be cautious in cutting rates. The FOMC minutes from the last meeting in July came out on Wednesday, and once again, the talk was about inflation. It's the greater risk. So we saw a lot of talk about inflation. It's all about inflation this week up until Friday. And here's the Federal Reserve's statement coming out, talking about their dual mandate, but they talk about the majority of the participants judged the upside risk as inflation as the greater of the two risks. So they're looking at labor and they're looking at inflation. They said inflation is the most important risk we have right now. There was also some talk about the elevated asset levels. Yes, so right now we have a situation where we've got stock market at an all-time high, houses at an all-time high, money supply at an all-time high, gold prices all-time high. There's a lot of all-time highs here, and the Federal Reserve is really being pressured to cut rates, but they did note that asset prices are inflated. They didn't say they would do anything about it. I don't think they really care. They really care about the bond market. They don't care so much about the stock market unless it really starts to have an impact on the overall economy. But if we see a drop in the stock market, I don't think they're necessarily going to come running in to save the day unless it becomes an absolutely huge impact on the economy. Okay, so let's get to Friday when Powell came out with his speech. And there was a couple of interesting twists in the speech. And this is why the stock market moved higher, I think. Because really, I mean, if you take a look at the swap probabilities for the Federal Reserve to cut rates on September the 17th, they've been around 85 to 90%, sometimes 95% in that range, which basically means the Federal Reserve is expected to cut rates, and they usually follow through at that point. So that was the expectation, and so Powell did indicate that they would be moving into perhaps a rate cutting cycle shortly in a number of different words, and then the stock market moved higher on that. Now, that was already expected, but there was a couple of interesting comments. The first one is they talked about the 2% target rate. And if you remember in the past, what the Federal Reserve was saying before, when inflation went above their target of 2%, they said, well, we're going to do this averaging phenomenon. And, because we were down so low for so long, therefore we have to be above 2% for a while before we really get concerned. They've got themselves in a box here because inflation's been above 2% for so long now that they can't say, well, we're going to take it below 2% and hold it down here to make up for when it was above 2%. I mean, that just really wouldn't go on over very well with a lot of investors and politicians, etc. So we saw them actually remove that phase. And they still talk about being anchored to the 2% rate, but they really start to focus on employment maximization here. So maximum employment. And they're focusing on that as compared to inflation. So Powell was saying, well, we have a shift happening. We were focusing on inflation before, last month, when the majority of the participants said, we're really focusing on inflation, not labor. And now they're starting to focus on labor, the employment situation. And here Powell basically came out and said, well, the unemployment rate's not so bad, but there's a lot of other stuff happening, and it's really hard to determine what's going on because different metrics are showing different things. But things could change really quickly. And I actually do believe that. And I do think the labor market's weaker than the headline unemployment rate number. So I agree with Powell on that. But I just found it interesting that a shift in 1 month. And I think this is a bit of an appeasement for Trump, I guess, and again for others as well, to say that this is what's going on. I think what's happening here is Powell is buying some time, and making slow concessions to Trump. Here we are into September, then we come along and perhaps we have another rate cut in December as well. And then, I think Powell's just dragging his feet on this here, and but just doing something. So I don't think he's going to be making any 50 basis point cuts here in the near future at all. I mean, there will become a time next year when the markets will be looking ahead and saying, well, the Federal Reserve Governor is going to change. We've just got Stephen Mirren. If he gets approved, he's not approved yet. He's just temporary. If he gets approved for the board, this week we saw another Fed governor get into hot water because she's been accused allegedly of mortgage fraud. I don't understand if it is true why they do this. Declaring 2 primary residences in different states to get lower rates. I mean, and we're not talking large amounts of money here, supposedly. A few $100,000 on the mortgage, and relative to the salary they make is just peanuts. I just don't get it. And the appointment position, I think, is out to 2036 or 2038. So there's all sorts of pressure on her to resign. She might be fired. So if you take a look, Trump's actually getting some people will have an opportunity to get some more dovish Federal Reserve governors on the board as well. So I think that's going to become more and more of a factor as we move forward. But the big thing is right now the market did see a pivot of some sort happening, more of a focus on labor, well, we'll have to see what happens, because even Powell said, these numbers are just so hard to really gauge right now with everything that's going on. And that comes back from COVID, because we saw so much stuff happen with huge amounts of money being dumped into the market and people being laid off and hired back and everything else. It's like an earthquake happening, and you get the aftershocks happening as well. And so we are really settling down from that still. But anyhow, we did see that potential for a pivot starting very shortly. I do want to point out that not everybody saw this as dovish. Obviously the bond markets, yields went down, stocks went up, everybody loved the news. Bitcoin, gold, everybody piled in. We saw all sorts of risk asset moves. So overall the market saw it as being a very dovish speech by Powell, but there really still was some hawkish tones in here, and he still talked about being cautious. And this is what I do want to say around this, and that is that in the past, when Powell has come out and made some statements and the market has reacted strongly to the upside, and the next week he's come out and basically started to say, well, actually, no, we have to be more the other way. And so really tempered that. And that's for exactly the same when the market's gone up or down. So he's really adjusted his speeches and position after the fact. So this is a signal here that we could actually see more of this happening here. And Powell coming out next week and saying, well, actually, yes, but we need to be more cautious, and this is going to be a slow process, and you watch those words happen. So we actually could see that affect the market in a negative way. Okay, but for today, on Friday, we did see the dollar relative to the world index drop like a rock when Powell talked, and that really was another factor driving the markets. And here you can see the S&P 500, Powell come out and talking to the press. And here we go. And that was the reaction. I do want to point out here that if we take a look at the ISM, which is one survey, and the PMI, which is another survey, they're showing totally different things. The ISM is actually heading down as far as employment, services employment, manufacturing employment, heading lower. But if you look at the PMIs, they're actually heading higher, including the PMI, which is new, but the PMI price indexes are heading higher as well. So maybe Powell's focusing more on this, but this is still out there. And then once again, this is a lot of the contradicting data that we're actually seeing at this time. So Powell is switching from inflation to labor. And I do want to say at this point, I think that the Federal Reserve is going to basically, probably in 2026, I think they're going to start to up their target from 2% to maybe 2.5% to 3% or something, and maybe the 3% is the new 2%. 2% was always nonsense. It really should be zero in theory, so maybe 1%, but there's no justification for 2% really at this point. But the market isn't buying Powell coming in and saying, well, inflation's under control. And we can see this here with commodities versus inflation expectations. This white line is the commodities sector here. And this is inflation expectations, which really haven't really moved up that much. But in the market, we're seeing investors switch out of a lot of growth and moving into the commodity sectors. Okay, so this is the U.S. Here's their current rate. It's at 4.5% for the federal funds rate. The expected cut for September the 17th is right now stands at 85% probability. That's not very much different than what it was before. In fact, it's actually lower than it was about a week ago. So we saw the market really react strongly, and the odds haven't changed that much. So we're going to have to see if this is a little bit of a one-day overreaction to what was already expected, but there might have been some add-ons on there that investors are reacting to. That's going to be what we'll see probably early in the week next week. On Tuesday, we saw the inflation rate come out for Canada, and you saw the news flash this number, 1.7%. That's below the target of 2% for Canada. And we saw all the press say 1.7%, 1.7%. We saw politicians coming out, I'm not going to name names, saying, oh, come on, Bank of Canada, you got to start cutting rates. You're costing us jobs and blah, 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 blah. So the focus was that Canada had a 1.7% rate of inflation. But hold on, I think there's more to the story than this. So if you take a look at this graph here, a complement of Richard Dias, he's put together this. This is the Bank of Canada rate in red, that's stair-stepping down. And he's put in 3 different inflation measures. And so right now, if we take a look here at the trimmed mean, which is what the Bank of Canada actually looks at. It really doesn't consider the headline CPI so much. It's said this many times. And it's at 3%. If we take a look at the weighted mean, that's actually at 3.1%. So both of those are at 3%. So if you take a look here, I'm going to show you another graph in a second as well. Right now, this area here, we saw negative interest rates. I'll show you that in a minute. But what we're seeing is interest rates, inflation rates, I should say, head higher as the Bank of Canada is lowering its rate. And I know a lot of Canadians saying, hey, 2.75% is too high. I'm sorry, 2.75% compared to historical norms is not that high. And one of the reasons why the Bank of Canada is not likely to raise or cut in the next meeting is it's actually done significant cuts already, and it's actually at a very low level at 2.75%. I saw this graph. The comments aren't mine, by the way, so you'll have to excuse those. But this graph, in this case, what we're looking at in red here is the Bank of Canada policy rate. And then the blue line is the Canada inflation rate. And you can see the policy rate typically has been above the inflation rate all the way down. In fact, the Bank of Canada rate has been much higher than the inflation rate in the past. And then what we saw here was we saw this inversion take place with the great financial crisis. And so we see that this red shaded area here is when we had negative rates, real rates, which means that the Bank of Canada rate is actually below the inflation rate. And look where we are right now. We're actually at the crossover point between the two. And so if the Bank of Canada starts cutting rates, we're going to get negative real rates again. I mean, this is not really the way you want to drive an economy. You don't want negative real rates happening, and it's important that Canada doesn't keep cutting, because if all of a sudden now we do need to stimulate the economy in the future and we've got interest rates too low, what do? You've used up a lot of your ammunition. Sure, the Bank of Canada can have other tools to use. They can do yield curve control, or they're going to do quantitative easing. You don't want to do those things. And the first line of defense really is the Bank of Canada rate. And right now, it's actually almost at a crossover point, depending on which inflation measure you use. But as far as going into the negative territory for real rates. If we take a look here, here's the expected probability of the Bank of Canada cutting its rate on September the 17th. Right now, it's at about 38.5%. So it's a little bit over a third. So the expectation is that they won't cut at the next meeting, but we'll see a cut happening in the following meeting. Earlier last week, I shot a video on inflation. I say the truth about inflation. And I did a little bit of an in-depth look at inflation in the US. I also talk about Canada as well. And go back to inflation after the Second World War, what took place there, and in the 1970s as well, and do some comparisons between where we are today and talk about where, in comparison, where we stand versus after the Second World War versus the 1970s, and what possibly could be coming up, and some of the dangers of where we are as far as inflation goes. If you're interested, please check it out. I posted it on X. I use my Substack as far as that goes as well. It's also on my YouTube channel. The best way to get those videos, once again, is to like and subscribe. And I'll be doing more of these videos in the future as well. Okay, so let's talk about some of the events that happened last week. One of the big ones was Palantir, which has been on fire, became an extremely expensive stock. Here's a graph, confluence of Bloomberg. And what we're looking at here is we're taking a look at the price to sales ratio, okay? Not earnings, to sales. Think about the math on that one. Okay, and here's Tesla, just so you know, as far as a growth stock goes, and here's Nvidia, here's Palantir. And what took place this past week was we saw a lot of investors go, my goodness, AI's gotten ahead of itself here. And this is, I don't think, a one-time event, by the way. As soon as investors start saying those type of things, and we see a big reaction to the market, now we can see a recovery take place, but then it happens again, and then we see it happen again. And that's usually what's the first stages of a rotation, when we see a rotation taking place into other sectors, and that could be it. Now, if something else comes along and hits this sector, that would speed up the process. But often when you see this happen, if we go look back at the extreme performance from certain sectors in the past, we see some real volatility when they start to sort of max out their performance relative to other sectors. I'm not saying that it's a bubble or it's a top or whatever. All I'm saying is, in this case, we tend to see those volatile movements when we start to see some rotation out of those sectors, or in this case, a stock with Palantir. And Palantir, despite going up so much, it went down 20% at one point during the week. Last week we saw Walmart stock fall as earnings miss forecast, which is unusual, despite it did say it has a good positive outlook, set to rise, but investors actually didn't like what they heard otherwise on the conference call, and you saw Walmart go down big time on Thursday, which brought the consumer staples sector down. On Friday, we did see Canada drop its counter tariffs on the U.S. There's some confusing news on that, and most sites are reporting it's covered by the tariffs that were covered by the free trade deal. Others are saying all the tariffs. It looks like it's a portion of the tariffs, the main bulk of them, that actually had gone against the free trade deal. I'm not going to make any other statements. This is just a quick update. Going around the world here, if we take a look at the 30-year government bond yields, Germany in red here has been going up, getting really high. Investors are saying, well, you know what? We don't like what's happening. There's been a lot of inefficiencies there. The UK, look what's happening to the UK. This is above 5%. The UK, it was going from here to here. And economically, that country's been a little bit of a basket case, but they're not the only ones as well. And I want to make a separation between investing in the stock market and the economies, because economies can be bad, but if there's other factors going on, you can see the stock market still do well because of relative valuation or rotation, the right sectors are in the right place or whatever it is. But the economies here are really starting to suffer. We can see that there's really a strong trend for the long bonds, the yields to be rising, which is basically investors saying, you know what, we still see inflation to be a problem. We see government spending too much money. We don't see them trying to fix this problem, and the yields are being pushed higher. This is Germany, okay? They came out with the GDP numbers this week. I don't want to spend very much time on this, but the actual came in at a negative 0.3%. Germany is the main engine of the EU. It's been in and out of a recession for quite some time. Back and forth, they've had bad policies, bad regulations, and they've really hurt themselves. Why is this important? Because they're the real engine of the EU, and they're helping to carry the EU overall right now. And if they keep stumbling here, we could see some trouble ahead. And here's the problem for Europe. And this is Italy here, and this is Greece here. And if you take a look, this is the government debt versus the 30-year bond yield. And this is the 30-year yield. I mean, it should be like this, but what we're seeing is we're seeing these countries get a free ride because of the EU. So the EU has something called a TIP transmission protocol instrument. if a country's suffering, they'll go in and buy their bonds, which basically means that the yields in Germany are higher than they should be, but the yields in other countries are lower than they should be because Germany is really helping to finance this. And this is a bad incentive for these countries because they say, well, I don't really care because we can just coast here. We'll get some help from the EU if we need it. On Friday after bell, we saw the US take a nearly 10% Intel stake. I still can't figure this one out. I'm not being political, but I really don't understand why they're doing this. I just don't get it. It baffles me why this is happening. But anyhow, just a little bit of an update. We'll have to see what happens to the price of Intel on Monday, but it's gone up a lot after they said they were going to be doing this. But anyhow, it's just confusing. Last week we saw China come out and say, well, we're going to actually take a look at limiting our companies buying NVIDIA chips from a few remarks because of a few remarks made by the Commerce Secretary. This is interesting because NVIDIA comes out with its earnings on Thursday this week, and we'll have to see what they have to say about this. This is also very interesting and relevant to what could happen on Thursday with NVIDIA. But what we've seen is we've seen Meta come out and freeze AI hiring after blockbuster spending spree. In other words, they're saying, well, we've spent so much money, we're going to pause here at this time. They're not saying everything's falling apart, but they did say that they're freezing hiring. Now, this is after the industry has been making some huge hiring moves. I know it's going to sound like kind of crazy, but we're seeing some of these top companies poach other people from different companies for $100 million a year or something. It's just absolutely insane. I had to check that one out myself, but absolutely crazy with what's happening. But now perhaps we're seeing a little bit of we need to digest what we've done already before we move forward. This week is Bank Week in Canada. We've got BMO before the bell coming out with its earnings, Scotiabank before the bell as well. On Wednesday after the bell, we got NVIDIA. I know I said Thursday earlier in the video, but it's Wednesday after the bell for NVIDIA. And if we take a look here, we've got TD Bank on Thursday before the bell, CIBC before the bell as well. So we're going to see some key earnings coming out this week. See what happens with the market. I think a lot of investors are going to be focusing on this one right here, NVIDIA. NVIDIA does have a reputation of beating its expectations and actually making some very positive statements on a go-forward basis. And to their credit, they've actually been living up to that as well. We have seen some other comments made about, perhaps the AI industry's gotten a little bit ahead of itself. It's a bubble and all of those sorts of comments. We saw Palantir really get hit hard last week as well. So I think if there is any type of negative talk or things aren't quite as rosy in the future, maybe we're going to grow at a slower rate for NVIDIA in the next little while we reconsolidate or something like that, I think we could see a little bit of a market pullback here. Coming into this performance for NVIDIA, a release, I think the market's going to be fairly quiet. This week I also expect a more tempered approach from some of the Federal Reserve governors coming out if they're talking. They do come up to their blackout period shortly as well, before their next meeting where they can't talk. So they do have some room here, a little while to talk about, is the market responding correctly? And we have seen this in the past, as I mentioned earlier, where they'll come out and clarify. And I think they're going to come out next week and say, well, yes, we think we have to start switching over to more of a focus on labor, but inflation's still important and we have to be very cautious. I think it's going to be more of a let's be cautious at this time. So I don't see them actually helping to drive the market higher. So we may see the market temper back here a little bit as well. Thank you very much for joining me today. Please like and subscribe the video. Thank you.